Welcome everyone to the Capital Wealth Management webinar. My name is Becky Records and I'm the Director of Retirement Plan Services at Capital Wealth. I'm joined today with Lee Duckworth, who is President and CEO. Today we want to provide a recap of the 2015 capital markets and discuss the greater than anticipated volatility that the new year 2016 has brought to your retirement account.
Well, thank you, Becky. Probably spend about 15 minutes or so, plus or minus 5. These are the topics we're going to discuss. The major economic events in 2015, what went on in the middle of the year with Greece defaulting on bonds, the slowdown of the economy in China, and then, of course, the story that was never ending, what's going to happen with interest rates. And because of the beginning of the year in 2016, we've actually added some information on the recent market volatility. There's a lot of information on this page, and so I actually suggest that you pause this presentation for a moment and digest all that information. All of this will be covered in varying levels of detail throughout the presentation. At the end of the day, we really encourage all 401k participants to seek out any of the advisors here at Capital Wealth Management and reconfirm that your investment allocation fits your own personal investment management strategy, and you sleep well at night knowing that you've got a consistent investment strategy. 2015, as you can see, broken out every 90 days, was truly a year of exceptional volatility. Quarter-to-quarter performance is noted here on the screen. All of the U.S. equity markets, large cap and small cap, were down. Large cap down almost a point, small cap down almost 6%. MSCI EFA, which is the mostly Europe, 22 countries, developed Europe dominated by England and Germany, and Asia, negative 3.3. And the Morgan Stanley emerging markets, also 22 countries. So these two indexes represent 44 countries, non-U.S. capital markets. The emerging markets dominated by China, India, and Brazil, they were down negative 17. Fixed income was also difficult. As anyone knows, what type of interest you're getting in your bank savings accounts or one-year CDs, the interest rates are still at historic lows. Please note the significant percentage jump in the fourth quarter. Obviously, this is due to Fed Chair Yellen raising interest rates 25 basis points. You can see the impact in the fourth quarter. This was a dominant news story over the 4th of July vacation. There were probably about 5 to 7 nightly dominant news stories on what was going on. The country of Greece formally defaulted on $1.6 billion of debt. This was not unexpected, and so this was not something that was sudden, and yet the impact of that is that the entire economy of the country of Greece the GDP is roughly the same size as the GDP of the city of San Diego. And so in the global economic perspective, it's really insignificant. And so we felt that the financial news media industry overplayed this story because of its political implications. The Chancellor of Germany got involved in the headlines, and eventually the debt was reconstituted. And so again, it did dominate the news cycle, caused some volatility, caused some investor behavior, but we thought it was really a non-story. Similarly, mid-June and then on into July and August, the third largest economy in the world, China, obviously continued to show increasing headwinds with slowing and reduced economic forecast. Yes, this did surprise investors somewhat but the question mark always remains about what is being publicly disclosed, what is the level of transparency, and what is the impact on other economies. Specifically, what is the impact on the U.S. economy and the S&P 500. And so, again, I do encourage you to pause for a moment and digest some of the economic data that we've laid out in the report. I would only highlight that of the entire U.S. economy, less than 1%, 0.7% of the U.S. GDP is made up by exports to China. And so the China market slowing down have little impact on what we're producing and exporting. Again, it's a story worthy of global discussion, and I would also connect this story with the delayed increase of interest rates. We actually were surprised in early September that Fed Chair Yellen did not raise rates. We thought that a quarter-point rise would be healthy and a good sign of that, quote-unquote, we've turned the corner. That was delayed, and during that delay, some more unfortunate global economic news continued to trickle out, which made the rising interest rates a less positive story, and yet still positive. Again, I encourage pausing and spending some time on some of the data points that we put on these screens. The implications is a stronger dollar, again, related to the slowdown of China. We are pleased that the Fed has done a good job at managing this process, causing what we see as slow and controlled interest rate, a slow and controlled interest rate growth environment. We think that's good for the capital markets. The capital markets, they don't like uncertainty. Again, I guess from a retirement plan perspective, we don't encourage daily market timing or daily market concerns of short-term up and downs. Not all news stories are relevant. We're in a world today where the financial news media industry is very large. You can get financial news from so many different sources on the web and blogs and just the mainstream media. Typically, stocks do have corrections up or down, and that is the natural cycle of the equities markets. So we believe that life will continue. The energy independence renaissance is continuing to grow in America. We believe that there is signs for a positive manufacturing growth and rebound in the next 3 to 7 years in the U.S. economy, being driven primarily by lower energy costs. And we're going to talk a little bit more about energy in a minute. We believe that strategy, for your retirement strategy, panic and fear, it's not a strategy, nor is greed. So we want you to be properly allocated, stick to that investment strategy through the ups and the downs, and continue to dollar cost average through your payroll deductions into that investment strategy. And obviously, the title of this slide is The iPhone 7 is Coming. It's coming in spite of a Chinese economy slowdown. It's coming in spite of rising interest rates, and that's a good thing. Just a moment on what has been going on over the last month. This is actually being recorded on Tuesday, January 26th. It was actually quite a positive day in the capital markets today. The S&P was up some over 280 points. What about oil? We have had a lot of calls and discussions with people about energy. What this graph shows you here is a textbook illustration of negative correlation. The top graph on the top of the page is showing the strength of the U.S. dollar and oil prices on the bottom. Very interesting. So what? Again, I think what we're trying to communicate here is this is not a new phenomena, and yet it is a rapidly in-your-face phenomena. No one anticipated back in 2014 that we would have such low energy costs at the pump right now. I think in the broader picture, we all want to sit back and understand that energy is cyclical, and this is not a new issue. It's being driven by increased technology. I'm going back and forth here because the technological advances of extracting U.S. energy, shale development, it's been all positive. Some of the things that have also caused the slowdown are, as we talked about earlier, the decreasing economic growth in the Chinese, third largest economy in the world. Last paragraph here, we want to do things at this time, and yet the result can be catastrophic for your retirement account, making short-term movements to try to time the markets. So we also believe in the buy and hold long-term approach to investing. In the last 100 years, this just gives you some historical data. Take a minute here again, pause the presentation. If we're in about a 10% decline year to date so far, the average length of that, and there's been many of them, is about 4 months, and the average time for full recovery is about 5 months. Just gives you the long-term averages over 100 years of market data, and I think it's comforting. The sky is not falling. Bear markets defined as a 20% decline. There have been nine bear markets since 1957, about a 50-year time frame here. It happens about every 7 to 10 years, and the average duration is about a year. I think important to note that the 3 bullet points, bear markets begin unexpectedly, their depth and duration are not known in advance, and their initial rebounds off the bottom tend to be very, very strong. So please, trying to time these markets is an exercise in futility. It generally results in less wealth long-term in your retirement accounts than simply having a strategy and riding out the short futility. Keeping things in perspective, the graph on the top, the black line indicates the S&P 500 large cap U.S. stocks over the last decade. You can see the decline back in 2008 resulted in a significant rebound beginning March 9th of 2009, and you had some steep and rapid inclines. Nobody knew that March 9th of 2009 was going to be that day. Bonds are the gold line, very slow and consistent, and so we advocate is a form of a balanced asset allocation approach or a target date approach, which is available in your retirement selections. Generally speaking, the further you've got to go until you're going to retire, the more growth-oriented or the more stock or equity exposure is appropriate for your portfolio, and the closer you are, the more conservative you want to be, which means less exposure to equities. That's a general principle. Again, I appreciate your time. We thank you for partnering with us to reach successful retirement outcomes. Again, this is Lee Duckworth at Capital Wealth Management. Please reach out to either myself or Becky Records. You can call us or email us at any time with any questions about your retirement investment strategy. Thank you very much.